If the silver price increases from, say, let's call it any number you want, 40 to 80, so the silver price doubles. If you were a producer making silver for 20 and selling it for 40, you have a $20 margin, and the silver price doubles, your margins quadruple, triple or quadruple. It's important to understand that. And the valuations of the silver stocks are discounting lower silver prices. If today's silver price holds, and I think they can, the net present values that we've ascribed to those producers are unrealistically low, and we have earnings surprises. If you have people trading off net present values established in preliminary economic assessments at $30 silver, and you rerun that same net present value calculation at $50, $60, $70, or $80 numbers, the difference is stark and it's dramatic.
The precious metals market has entered a phase where price is no longer quietly advancing in the background, but actively forcing capital to reposition. Silver has now surged through yet another historic milestone, breaking above $99 per ounce and confirming that the long-anticipated repricing of monetary metals is no longer theoretical. What was once dismissed as improbable is now unfolding in real time, reshaping assumptions across the entire precious metals complex. As silver moves higher, the conversation naturally shifts. The metal itself commands attention, but beneath the surface, a more consequential dynamic is taking shape. With more than 5 decades spent analyzing natural resource cycles, Rick Rule has observed repeatedly that the most lucrative phase of a metals bull market often occurs not when prices are merely rising, but when equity valuations fail to adjust to new pricing realities. His focus, particularly in the silver space, has long centered on how margin expansion and net present value recalculations can dramatically alter the outlook for high-quality producers and developers once higher prices persist. In this discussion, Rule lays out why silver mining equities may now represent one of the most compelling expressions of the ongoing silver bull market, not because silver must continue exploding higher in the near term, but because even today's prices materially change the economics of production. If you appreciate clear, disciplined analysis grounded in numbers rather than emotion, be sure to like the video, subscribe to the channel, and turn on notifications so you don't miss future discussions. Let's get into it.
I save in gold. I maintain liquidity in US dollars. We could talk later about what would cause me to sell my gold, but this price isn't one of them. As you suggest, I'm a contrarian. And you and I talked a couple years ago about silver being a hate trade, and I bought it. I bought it because I thought when the hate subsided that the silver price would increase. Guess what? That happened. In my own portfolio, silver represented in my portfolio a speculative asset class, not an investment class, a speculation class. And the reason that I owned it is because it was hated. And when that reason went away, the silver price went up. So last week, I sold 80% of my physical silver. This is a personalized decision. It might not apply to the rest of your listeners. But I note that the internet response to my announcement that I sold 80% of my silver was filled with hate. So I know I did the right thing. When X is widely lined up against me, I know I'm correct. Now, it's instructive to note what I did with the money. Some of the money, a small amount, I put back into physical gold because insurance is more important than speculation to a rich 73-year-old like me. More than half the money, as it turns out, I put into silver equities because the silver price just has to stay the same rather than increase for the silver equities to do better. The silver equities are discounting about $40 or $45 silver. If we're really in a period of $75 or $80 silver, the silver stocks have to play real catch-up. And so I believe that the silver equities are a better receptacle of my speculative capital than silver is itself. Silver just needs to maintain today's price for me to be rewarded in the silver equities. Silver needs to increase for me to be rewarded in the physical silver. And I believe I have a durable competitive advantage relative to other investors and speculators in the silver space, 50 years of experience in analyzing silver equities. So as a speculative asset class, the silver equities are more appropriate for me personally than silver is itself. Other speculators will need to ask that question themselves as to whether it's appropriate for them. Sadly, many speculators don't know how to question themselves, so they likely won't be able to attract an answer. Make no mistake, I believe that the precious metals bull market and the silver market have a lot further to run, but that doesn't matter to me. What matters to me is that I'm a disciplined speculator. The reason to own my silver went away, and there is another asset class that fits in that part of my portfolio better. So I shifted to it.
Perhaps you could shed some light and walk us through the dangers of getting so emotionally attached to an asset class.
Most people, particularly undisciplined people, and this will generate a lot of hate all by itself, can't invest in a narrative until the price momentum of the underlying commodity has justified the narrative. Everything that is true about the silver narrative today at $80 was true at 20. The difference is that if the silver price goes from $20 to $80, the value of the narrative is arithmetically only a quarter as great. The coiled spring aspect of silver is used up. People need to understand that. If your reason to own it was mine, which is to say the alleviation of hate, that's occurred. Am I saying that the silver price can't go to $200? No, I'm not saying that at all. I don't care. I bought it for a specific reason. The specific reason came true. I expect over 10 years the price of precious metals, including silver, to be not merely higher, but a lot higher. I have found what is for me a more attractive way to express my preference for the silver trade. I will tell you this. I know how good my timing is and how good my underlying thesis is by how much hate it attracts on X. 10 years ago, I remember proposing renewed investments in the uranium sector, and people were apoplectic in their hate. This is a failed bull market. The stuff has gone nowhere. It's the stuff of Hiroshima, Nagasaki, 3 Mile Island. Fast forward 5 years, and I disclosed that I sold some of my uranium stocks. What a half-wit, they said. The guy steps out of a bull market. Can you imagine anything in the world more stupid? Then the uranium stocks declined, and they say, well, the guy was front-running, right? I know that if I get 30 responses in social media and 25 are violently opposed, that I'm doing precisely the right thing. That's the narrative I look for. Monetary debasement. We can discuss that if you want in your show. We can discuss why the purchasing power of the US dollar and other fiat currencies is going to decline. We can discuss why precious metals are going to be the beneficiary of that. Happy to have that discussion. Believe it to be true. Probably after 55 years in those markets, I know it more fully than many of the geniuses on X. Happy to do that. Let me introduce some other things to them, though. Let's introduce a little history just for fun. As you can tell by looking at my image, I've lived it. In the decade of the 70s, the US dollar lost 75% of its purchasing power. Not coincidentally, in the decade of the 70s, the gold price rose from $35 to $850. There is some correlation between the deterioration of the purchasing power of the US dollar and, importantly, real interest rates in fiat currencies and the reaction to the gold price. That's the good news, because I suspect that in the next 10 years, we'll see another 75% deterioration in the purchasing power of the US dollar. I say good news advisedly. And that should fuel continued increases in the gold prices. But a couple things you need to know. While I believe that in very rough terms, the nominal price of gold, the US dollar gold quote, increases in inverse measure to the deterioration of the purchasing power of the US dollar, what I guarantee is volatility. We will experience in the next 10 years at least one, probably two, 30 or 35% declines in the gold price. We experienced 3 of them in the decade of the 1970s.
What makes Rule's framework compelling is that it separates belief from execution. He remains constructive on precious metals over the long term, yet refuses to let that conviction override portfolio discipline. In his view, silver served a specific purpose, a speculative instrument purchased when sentiment was hostile and expectations were low. Once that hostility faded and price responded accordingly, the trade matured. At that point, holding silver simply because one remains bullish on monetary debasement becomes inefficient. Markets reward timing, not loyalty. This is where Rule's analysis transitions from metal to leverage. Silver equities, unlike physical bullion, do not require higher prices to generate improved outcomes. If prices merely stabilize, operating margins expand. If prices rise modestly, earnings can surprise meaningfully. And if prices rise sharply, the repricing of net present value becomes nonlinear. This is the dynamic Rule emphasizes, not speculation on headline price targets, but structural leverage embedded in mining economics that the market often fails to discount correctly.
I'm interested in the silver miners, not the silver morons. There are a whole bunch of companies that have silver in the name on the share certificate, but they don't have any silver. And realistically, if the price of something that you don't have goes up, it shouldn't impact your underlying value. But when I look at the silver producers, when I look at, say, Pan American Silver, which paid a very, very, very full price for MAG, a full price at $30 silver, and I think about the fact that the Bay Street research reports and the Wall Street research reports, when they look at earnings, are assuming a $45 silver price. If you make the stuff for 75 and deliver it into a forecast of 45, it's impossible that you don't have an earnings surprise. The second thing is that when old securities analysts like me do net present value calculations, we still do those things. If the silver price increases from, say, let's call it any number you want, 40 to 80, so the silver price doubles. If you were a producer making silver for 20 and selling it for 40, you have a $20 margin, and the silver price doubles, your margins quadruple. Triple or quadruple. It's important to understand that. And the valuations of the silver stocks are discounting lower silver prices. If today's silver price holds, and I think they can, the net present values that we've ascribed to those producers are unrealistically low, and we have earnings surprises. It's as simple as that. I feel good about the silver price over 10 years. I think that 2026 is probably a good year, but I don't think it's a year that repeats the performance that we got in 2025. So I don't want a big bet on my part in a near-term increase in the silver price. What I want is a bet on the increase in margins and the increase in net present value on the more efficient producers, or on the very, very, very high-quality developers where mine construction looked fairly certain at $35 and you go into an $80 world. If you have people trading off net present values established in preliminary economic assessments at $30 silver, and you rerun that same net present value calculation at $50, $60, $70, or $80 numbers, the difference is stark and it's dramatic.
Are you looking more towards those developers at this point in time, or are you deploying capital to the big producers like Pan American Silver, or all the above?
I have all of the above. I'm in a market where I think I'm right and where I think that the underlying move is going to be fairly dramatic in terms of the big names. I tend towards beta rather than alpha. I like the probability of a triple more than I like the possibility of a 5-bagger or a 6-bagger because I like the difference between probability and possibility. So I added to some Wheaton, not primarily a silver stock, but still has a silver cult and still produces an awful lot of silver. And the free cash flow estimates around Wheaton are certainly understated for the increase in both the gold and the silver price. It's important to note that. I own Pan American because I think there's earnings leverage, but I think there's a different kind of leverage that the market has completely ignored. And that is the leverage exhibited by two undeveloped silver deposits, one in Guatemala, one in Argentina. These are each 500 million ounce high-grade deposits that aren't figured into the net present value because they don't have any. They don't have any because of political constraints to development. The governments have paid some attention to domestic politics, ignoring the fiscal benefits that will come to the state. The state generally tries to steal somewhere between 35 and 50% of the economic value of a deposit after the payback of capital. That was a fairly small number in these two deposits at $20 silver. The benefits to Guatemala and Argentina from stealing, let's call it 35% of the economic benefit after a recoupment of capital are billions. And I don't believe that either government can afford to leave these two deposits unbuilt. And you get that in Pan American for free. Free is a very good price. And I'm particularly attracted to redundant assets on the balance sheet that don't contribute to current cash flow estimates, but still have residual value. The option value of these two deposits in Pan American, while by no means a certainty, ignores the fact that governments who could ignore the revenue because it was small relative to the domestic political price that they'd pay for development, that avoided revenue in both Guatemala and Argentina is just too high. I believe that there's a probability that a political accord will be found, and that those assets will go back onto active status in that balance sheet as opposed to passive status.
The broader context matters. Precious metals are not rising in isolation. They are responding to declining real interest rates, expanding sovereign debt, and the steady erosion of fiat purchasing power. Rule draws on historical precedent, particularly the 1970s, when sharp volatility accompanied a long-term upward trend in gold. That period delivered extraordinary gains, but only for investors who survived multiple brutal corrections along the way. Volatility, not direction, remains the defining feature of secular metals bull markets. This is why emotional attachment becomes dangerous. When investors anchor their identity to an asset, they lose the ability to assess risk objectively. Rule observes that many participants embrace the narrative only after price momentum confirms it, at which point much of the asymmetry has already been consumed. The irony is that the fundamentals supporting silver today were largely present when it traded far lower. What has changed is not truth, but perception. In the mining space, however, perception still lags reality. Many silver producers and developers are valued using conservative price assumptions that no longer reflect the macro environment. The cost structures, development thresholds, and feasibility studies were built under materially lower silver prices. When those assumptions are updated, even modestly, valuation models shift dramatically. This is not theoretical optimism, it is arithmetic. Equally important is optionality. Assets that do not contribute to present cash flow often carry no value in standard models, yet can become highly material when political or fiscal realities shift. In jurisdictions where governments once resisted development due to domestic pressure, rising fiscal stress may alter incentives. When states require revenue, previously stranded deposits can move rapidly from dormant to strategic. Investors positioned ahead of that transition acquire upside without paying for it. And that asymmetry is precisely what disciplined speculators seek. Ultimately, Rule's message is not about predicting silver's peak or forecasting exact price levels. It is about understanding where reward is improving relative to risk. Physical metal provides insurance. Mining equities provide leverage. Both have a role, but not always in equal measure. As bull markets mature, capital must migrate toward the segment offering the greatest marginal return per unit of risk. That migration, not headline prices, often defines the most profitable phase of the cycle. If you found this analysis valuable, consider subscribing for more in-depth discussions on precious metals, mining equities, and the macro forces shaping capital markets. These cycles reward preparation, patience, and discipline, not emotion. Thank you for watching, and I'll see you in the next one.